what we would like to do in the next 10 to 15 minutes is give you a very brief, concise, but comprehensive overview of the CEE investment markets. A lot has happened since, let's say, last time we met in February or so. You're also in the same room. At that time, we were speaking about a lot of capital to be invested in Central and Eastern European real estate, which to an extent has happened. That interest still exists, but we also spoke about limited investment opportunities at that time, essentially on the prime end of the market. And that is something that we've seen, let's say, the market being confronted with, especially in Czech Republic and Poland. The interest has been high both in offices, retail, as well as in industrial. However, the opportunities from a supply side have been limited, and therefore we've seen quite a considerable drop-off in investment. The purpose of this meeting is showing, let's say, opportunities beyond Poland and Czech Republic, and I will touch upon a couple of aspects that might be very interesting from your point of view. Where I would like to start with is a bit of, let's say, optimism on the economic side of the market, so the growth that we are seeing still in Central and Eastern Europe. But on the left-hand side, you see countries, Czech Republic and Hungary, that in the lighter green color showed considerable growth still last year, around 1.5 to 2% real growth. But the main, let's say, positives were visible in Poland and Russia, a real growth of around 4%. In Russia, we're again expecting to see 4% this year, real growth. In Poland, it's slightly coming down to around 2.5, 3%, but still this growth is continuing also into next year. If we are looking at the figures for Czech Republic and Hungary, very open economies, export-import driven, they are really feeling the impact now of slowing German growth, and therefore for the end of 2012 we are expecting a minus of around 1.2%. Overall, comparing that to the Eurozone growth, generally CEE is still outperforming. Eurozone growth is expected to decline around 0.5% for this year. Then over to investment numbers. These are the investment numbers for Europe. And we all know that these volumes came down quite considerably since 2007, 2008. But what is quite interesting is that these volumes remained quite stable afterwards. So after an increase in 2009 again, it shows that there is still a considerable amount of equity in these markets, and that type of equity is quite stable over the years. If we look at this line, the share of CEE in the total European turnovers, it's visible that we came from a situation where CEE accounted for 6% of European volumes. It spiked to around 12% in 2008 and 2011, and is now back at 6% again. And I think this is a realistic normal. This was caused by a delay effect. In CEE, it tends to be the case that the trends that we're seeing in Western Europe come to CEE 3 to 6 months later. But here, the spike was caused by a lot of product availability. A lot of large shopping centers last year were sold, several large office buildings, a lot of activity in Russia as well, and therefore the liquidity moved up very quickly. And as I said, I think this is a level that is quite normal for CEE again. In terms of CEE investment turnover, so that's combining Central Europe, Eastern Europe and Southeastern Europe, as I said, the volumes are down considerably again. It's quite interesting to see, and these are the numbers for Q3 until end of August, is that especially in Central Europe, the volumes are now slowing. And this is quite interesting, and I think this is mostly driven by the supply side. Whilst in Russia, the demand and the actual deal flow that we're seeing is still very, very strong. So what this indicates is that there's hardly any transaction activity happening in the segment below the top end of the market. If we're zooming a bit further into Central Europe, so that's a combination of Poland, Czech Republic, Hungary and Slovakia. The yellow line is the most important part of this all, I think. Out of the Central European volumes, around 90% is happening in the two markets, Poland and Czech Republic, and then especially in Poland, as you can see here. So Slovakia and Hungary are still very liquid for the moment. If we look into office investments and break it down by city, this orange line is indicating the total deal flow in capital cities compared to the overall office deal flow in Central Europe. And over 80, but in most of the years, close to 90 to 100% of the deal flow in the office segment is taking place in the capital city. We've seen some regional deals recently taking place here. One of them was in České Budějovice in the Czech Republic. One of them was in Gdansk. Arkonska was sold to a Polish institution. And then we saw a regional deal happening in Romania. But I think these are exceptions and not really the trend in the market. I think on yields, generally, if we are comparing prime office yields in regional cities versus capital cities, you're roughly looking at a spread of around 150 basis points. An exception to the drop in investment activity is the industrial segment, where apart from the spike in H1 2011, volumes have been relatively stable. And this has been caused by a lot of development activity and pretty good leasing over the last couple of years. When the markets came down in 2008, there was a lot of speculative development underway, and therefore in the medium term quite a lot of oversupply was the result, especially in Poland and Czech Republic. Due to a lot of leasing, the vacancy dropped there quite considerably. So based on that, high quality portfolios being sold, the investment flow has been strong there. And especially in the southern parts of Poland, we are slowly but surely starting to see some rental growth again. Overall, industrial investment is around 15% of the total CE investment. One major driver of the volatility in CEE's markets is the fact that cross-border investors are extremely important in CEE. In the years 2007-2008, the share was around 90%, and it has dropped to around, let's say, 50-55%. Of course, as a result, the local purchase activity is going up, but that's a result of the fact that the market is very small. Some examples of local purchasers are in Czech Republic CBRE, some insurance funds in Poland, PZU for example, and some other closed-end structures in Poland. And then, of course, local Russian activity, which is included here as well. The changes in lot sizes of investment have been considerable as well. Just very briefly for Central Europe, on the left-hand side, the numbers for 2003, roughly around 50 to 60 million per deal. Currently, we're looking at somewhere around 25 to 30 million. So very roughly, the lot size is halved across Central Europe. A similar picture visible for Southeastern Europe, but as I said, the number of deals considerably lower here. A significant drop since 2008 when the market collapsed there. Currently we're looking at an average deal size of around 25 million. The main exception, and that's why the scale was so considerably higher, here is Russia, especially because in Ukraine we hardly saw any deal flow. We're looking at an average deal size there of around 100 million plus and increasing. So it's really, really big. Single assets, like for example the Ritz-Carlton being sold, at the Galleria shopping center in St. Petersburg, several large portfolios. So it's quite a different trend there. Most of you will have seen this slide, but for those who haven't yet, what I've done here is I indicated the risk spread between the German government bond yield 10-year and the weighted average prime yield for Central Europe, compiled from Warsaw, Prague, Bratislava and Budapest. The spread between the two indicates more or less how interesting still for institutions real estate in Central Europe is. We're currently looking at over 500 basis point spread between the two, and that was the situation at the end of Q2 2012. The bonds decreased even further in the meantime, and yields for the time being stayed stable, so the gap is actually a bit bigger than this. But comparing this to the state of the markets back in 2003 is indicating what, let's say, real estate as an asset class for institutions still can offer. The sharpest yield that we are still seeing in Central Europe is around 6.25 for prime offices in Warsaw. And I think this is one of the things that the panel may go into a bit more in detail, because there are some changes happening to yields already. I don't want to go into this into too much detail, but what is interesting is that we're seeing some yield movement across Europe. And I highlighted in green the markets where we've seen a 20 basis point plus movement across Europe. And this upward movement in yield is mainly visible in the southern European markets, as well as in some regional UK markets. I'm not saying that in other regional markets across Europe that's not happening, but we're keeping track of these markets on a structured level. So it's, let's say, it's clear that the economies that saw the largest hit are currently also reflecting that by yields moving up. One thing that I would like to highlight on the occupational market is Warsaw. What we've included on this side is on the y-axis the current vacancy rate for offices in Warsaw, whilst on the x-axis we included the pipeline under construction as of the percentage of current stock, and that's running until the end of 2013. Warsaw came from a situation where I think a year ago where it was located there. So coming from a low vacancy situation and a low pipeline, due to very active, mainly speculative development in that market, it's now quickly moving up. The rest of the markets is relatively stable with the exception, I guess, of Moscow, but it's indicating that beyond Poland, limited office construction is happening still, with a few exceptions in Prague. And I think, again, this is a topic that the panelists may add some further comments on. Then there has been a lot of discussion in terms of distress in the market. I simply wanted to calculate how much distress that we've seen in CEE, so including Eastern Europe, and I compiled these numbers over the period 2009 through the end of August 2012. And out of the total volume that we've seen happening, only 5% we can classify as distress. So that's, for example, auction sales or open market transactions, and it doesn't include corporate deals. So actually only a small part of the total deal flow that we've seen happening we can classify as distressed. Over the years there hasn't been, let's say, a strong increase, so it has been relatively stable. And as you can see, the split between the regions is relatively stable. I would have expected initially that the share for Southeastern Europe would have been bigger, but it hasn't been. And recently, I believe your magazine announced the auction of Liberty Center in Bucharest, which was an example of one of these distressed deals. But I cannot really say that that amount is truly increasing.